Think getting a home loan is hard as a doctor? It gets even trickier when you have ABN income, parental leave gaps, or want to buy through a trust or SMSF. But those obstacles, they're solvable if you know what to ask for.
The biggest thing you can do to help yourself if you are doing that sort of work and contracting through a lot of different entities through an ABN is to keep your accounting software updated and use an accountant or a bookkeeper, because if you're wanting to borrow money, the more documentation we can provide to support that short-term ABN income will help our case.
Banks love lending to doctors, but most of their systems aren't built for how doctors actually earn. Short-term contracts, multiple jobs, moonlighting, or maternity leave can crush your borrowing power unless you're working with someone who knows the hidden policies designed for you. Don't take no for an answer. If you've approached someone else, such as either as the bank directly or a non-medical, more generic lender, and they've said, oh, we can't do this, it doesn't mean it can't be done. In this episode, mortgage strategist Alissa Childs breaks down real-world case studies, from getting loans on short-term ABNs to financing through trusts and super to saving doctors tens of thousands of dollars just by renegotiating bad interest rates. Whether you're building a 5-property portfolio or just trying to get your first approval, this episode is a playbook for turning a no into approved. Now let's get into it. Hi, welcome back to another installment of the Investing for Doctors podcast. I'm your host, Dr. B, and I've got Alissa Childs back with me again today. Welcome back, Alissa.
Thank you.
All right. So for those that have not listened to us speak before, quick introduction.
Yes, my name is Alissa Childs. I am the co-founder of a mortgage brokerage called Two Birds, One Loan. We're based in Sydney, in Glenorrey, little rural suburb, northwest Sydney, and we've been operating now for 8 years. However, I have been long-term member of the financial services industry, working across a number of financial institutions, and we joined with the IFD group last year to be the mortgage brokerage partner for the group, which has been amazing.
Yeah. Welcome.
Thank you.
So, now that we've been sort of operating for 12 months now, I'm sure you've seen all sorts of different case scenarios, examples in the medical space, and how it's a bit tricky sometimes to assess doctors' earnings and serviceability and all that sort of stuff. So I think I want to dedicate this episode to give our listeners a sort of a showcase of the different things that we can do to help our doctors, our dentist clients actually get the best loan they can.
Yes.
All right. And
sure.
now, so I guess the easiest is, someone on PAYG, right? I guess that's the easiest. You're a salaried employee, and you've that's the only source of income you get.
Yes.
I mean,
these are the easiest ones.
Yeah, and how does that process work, and how does that look like? When you're trying to.
So it depends on the time of year that you're applying as to how we would assess that income. Generally, by this time of year, we're recording in November. We can annualize with most banks, not all banks, annualize the year to date to determine the overtime, because obviously a lot of people in these positions get overtime allowances. There are plenty of banks that will annualize once we're 3 months into the financial year. There are some banks that will annualize 6 months into the financial year. There are other banks that will still look at last year's earnings and compare them. So it really depends on the circumstances as to which bank we would end up using. Another common thing we see for a PAYG doctor is salary sacrificing. So there can be for cars, there can be your $346 per fortnight of, $9,009 per year that you can salary sacrifice as tax-free income, and that just comes back to you as a payment that you can use for any purpose. So that commonly some banks will add that back as taxable income, and some banks will factor that as tax-free income for you, which changes your servicing. So there are a lot of little nuances between the bank policies, but essentially that's what we're looking for. We're looking for your base, your overtime. If you're working in a hospital as an essential service, a lot of lenders will take 100% of your overtime and allowances. There are some banks that will shade it to 80% depending on your position. And there are some banks that will even shade the allowances to 80%. So we break this down. We look at your goals, what income or what's your goal on what you want to purchase for and borrow.
Yeah.
And then we might take you to a lender depending on your goals.
Yeah, what that number looks like. Yeah. So even though it's straightforward, it's not that straightforward. Because
you just have to know the broker has to know the policies and the small little differences between how these are assessed for medical professionals.
So to summarize, you have your base salary, which is, it is what it is. Then there's the salary packaging stuff, which they may take that as before or after tax.
Yeah.
Then there is the overtime allowances, where they annualize depending on how many months have gone by, or they can use previous years.
Yeah.
And
the leases.
And the leases and
they
all the
all
other
assess
expenses.
those differently
And they assess
too.
them
So
differently.
some will just take it as a liability, which is then buffered with a percentage on the liability rate, essentially. Others will take the pre-tax deduction off your income and factor the rest as an expense with no buffer.
Yeah.
So we've got a spreadsheet alone with the policies on how to assess the novated leases because they vary so much between banks. Yeah, you wouldn't realize.
As you said, because some of them will view that as a liability, which will reduce your serviceability.
Yeah, because that's being buffered. Whereas some just take it off your pre-tax, post-tax income.
Yeah.
Which those two things alone can fluctuate your capacity when you have a novated lease. Novated leases are serviceability killers. In general, they really are.
Yeah.
I think we've spoken about this before, but for that reason alone, obviously it affects your borrowing capacity. But then as a minimum, we have to look at household expenditure. A lot of doctors are under the minimum. We have to take the minimum. Which includes an expense for transport. But when you have a fully novated lease that covers your transport, we still have to factor in your minimum living expenses. So sometimes it can double dip on your
expenses calculation. Yeah. So it's about income, expenses, and what are the liabilities. And I think if you're earlier in your career, you probably still have HECS debt. And that's another thing which will reduce your serviceability.
There are some changes happening there.
Yeah.
So
is there?
Yeah, there is. I'm starting to see there's one bank that came out and said they're not going to actually factor it in anymore. So I think we'll start to see some changes filtering through there. But at the moment, the HECS does make quite a difference, especially if you have a big income. I had a client last week that she had a HECS debt and she was earning $160,000. And when you've got a big income, sometimes it works in your favor to pay the HECS out to use your whole taxable, because she was losing a couple of grand a month from her taxable, from her net salary because she had this HECS debt. So when you've only got a small income, the repayment's small, but when you have a big income, the repayment's big. Yeah. So
because it's two things: it's the payments and the liability.
Yeah, but it's often just the payment because the actual amount of the debt doesn't change your capacity.
Oh, it
interestingly.
Doesn't at all. Okay.
So whether you owe 5,000 or 100,000, it doesn't matter.
Okay.
It doesn't. It's all on your taxable income.
Serviceability, but it affects your HECS payment, it affects your net.
Yeah, because you're forced to pay more to HECS when you earn more.
Yeah.
Whereas if you're earning under the threshold, you pay nothing.
Yeah.
So you might have $100,000 of HECS and your income is under the threshold. We don't have to factor it into servicing.
Okay.
Yeah.
Well,
and
this
don't realize about this.
Yeah. And this is the most simple scenario, I would say.
I
So let's, there's obviously a lot more complicated ones. Now, other things such as investment income obviously also gets thrown to the pile. Is there a shading on that as well?
I mean, depending on the property.
Yeah, so property investing, it'll be shaded.
Yeah, everything's shaded.
Yeah, everything's shaded. But
everything's worst case scenario when they assess borrowing capacity.
Yeah.
So I think some people are a bit surprised when they're like, I can afford so much more than that. But it's in reality, we know that. But they're looking at what if the rate's got 3%? What if you spend $50,000 of your credit card limits? We're going to assume you've done that.
Yeah.
You know, like that's what they're looking at.
Yeah. And credit card debt also is another big one.
Serviceability killer, even limits. So, you know, in the past, they used to allow us to leave off the credit card limits if you pay it off every month. But the regulator went down on that a few years back. And now, even if you have 100,000 of limits, you've never touched them, they're assuming that you owe 100,000 on those.
Yeah, and they assess it assuming that you're paying the interest on them as well,
yes,
isn't it?
They do.
Which is what, 20 or 18% interest?
Yeah, or 3% a month. Yeah, it's something like
some
that.
Crazy high number.
It affects your capacity a lot. So, they're not great to have. It depends. Like I've got one client this week where they had 80,000 of credit card limits, but services with them, so they keep them. But if it's affecting you to the point you can't borrow what you need, we drop them. But we usually say don't drop them until we have a loan approval. Because we want your loan to be approved before we go dropping credit cards. So we ask the bank, hey, if we condition for this card to go from 20 to 10, will you approve it? And they say, yeah, approved subject to dropping it to 10.
Yeah. And then just go contact your creded card issuer and ask them to drop it. Yeah. Awesome. So that's the most straightforward scenario. Now let's add a bit of complication into it. There's a lot of doctors would sometimes do moonlight on the side, on the ABN, do a bit of locuming work. And some of that will be salary. Some of that is actually on their sole trader ABN. Now, if it's on a salary, but it's casual ad hoc work, how does the bank assess that?
So casual generally, as a PAYG casual role, we would want to see at least 6 months in the role. Very rarely there might be a bank that might consider it after 3, especially for a medical professional. But as a general rule, 6 months. This is a common scenario where we have people that have multiple jobs.
They've got multiple fractions in different spots.
I think one that the most I'd seen was, I think this guy was working for 5 hospitals and had a salary, 5 hospitals under the ABN contracting too. So, but they were all coming through the ABN, but then we had a salary, but you're sort of annualizing the invoices from every role. I think the biggest thing you can do to help yourself if you are doing that sort of work and contracting through a lot of different entities through an ABN is to keep your accounting software updated and use an accountant or a bookkeeper because if you're wanting to borrow money, the more documentation we can provide to support that short-term ABN income will help our case. So they want to know what's the sales, what's the expenses, what date did it all start, that sort of thing.
And they probably want to see a cadence of it rather than, I've just, I want to boost my thing. So I've done like a whole month of hardcore locuming.
That's right.
Then it doesn't annualize like that, is it? It's more on the
smallest amount we can annualize, the smallest period is 3 months.
And again, that's different depending on the lender, isn't it?
Yes, that's one lender that will do that. And this is such a niche policy that, there's a couple that will do short-term ABN income. The mainstream policies and lending teams will not touch these. These are specialised teams that will do them. For doctors only.
And so that's a scenario where you have a PAYG employee with additional casual or additional ABN work on the side. So usually they may only annualize it if, say, there's some cadence to it.
So that generally, what they'll want to see is the most recent BAS. So if you have 1 or 2 or 3, we need to see all. But typically the policies, if you're under 12 months trading on the ABN, that's where we can look at something outside of the box.
And if you have more than that, then just give them everything.
But they sort of want to see, they want to understand when did you start working, if it's a GP, for example, when did you start working with this clinic? Show me one of your invoices and we can figure out the billing and the service fees.
Yeah.
And how it's all sort of paid.
Okay.
But yeah, typically there's 30 or 40% fee, and there's not really many other expenses to take off.
Yeah. And then obviously the next step is when they lose that PAYG income and they're just fully contracting or ABN. And that's also relatively, not say straightforward, but that's easy if you have all of the accounting and the bookkeeping data, isn't it?
Yeah.
And
the more data you can provide, the better. And they still like to see your most recent lodged tax return and notice of assessment, even if it's irrelevant to your current job. They still ask for that. So it's still important to keep your tax returns and things up to date. We've had some success lately because obviously FY25 returns are not yet due.
Yes.
So, but if we want to use the FY25 income, they don't want to lodge the returns until they're due, because then the tax will become due.
Yeah.
So we've had some success with certain lenders where they'll accept final tax returns for FY25 that are not lodged.
Yeah.
So they'll assess that income.
Yeah.
We have to show the money in the bank for the tax that will be due, and we have to get a very specific letter from the accountant stating these tax returns are finished, they're final, there will be no changes, and they will be lodged when they're due. And then we show there's savings to pay the tax when it will be due, and we've had exceptions done there with certain banks, even at 95%. To take that. Okay. So that's a niche, that's an exception, but we've had success 2 banks that will do that at the moment.
Okay. So that's obviously another extreme of things. But I think you mentioned earlier the shortest time period they will analyze is 3 months. It's basically 1 BAS, isn't it?
Ideally, we want to see 1 BAS.
Yeah.
Yes, that's right.
I think 2 BAS just makes things a lot easier.
Yeah, that's right. So, whether we're annualizing 1 or 2, they will only annualize out to 11 months rather than 12. So they shave off a month for fluctuations.
Oh, right. Then I do that. Yeah. Okay.
And
so
then
more shading.
Yeah, I know. It's still very generous.
It's very generous.
This policy is quite amazing. Yeah.
And okay, so then I think this covers most of the scenarios in which most doctors work under. Now, the other thing that comes from time to time is parental leave.
Yes.
Yeah. How is parental leave?
Parental leave, it affects your it affects your annualization. Like if you're on an ABN, because obviously you've had time off.
If you're in your ABN, then you're not going to get much money. Yeah.
We can't, if we're going through one of the specialist health teams, we could probably massage those a little bit depending on the circumstances, because, if we can show projections and we've got a quarter of return to work.
Let's use maybe some concrete example.
Yeah.
Say someone who's on an ABN has taken 6 months off.
Yeah, I actually have a live example of this right now.
Yeah.
So this
how is that approached?
This person had taken 3 months of leave between April, May, June, I think it was, of this year. So that, and only started on the ABN 3 months before that. So there was only 3 months trading in that year.
And then 3 months leave.
Yeah, but as of July has started doing certain set hours as a specialist. But then, had some time off or something. So yeah, it's really hard to show what it will be. So in this case, we're going with the projection method. So the accountant has provided us with a 12-month projection. So they've said, based on this many patients per hour at this amount of income per patient.
Oh, wow.
And these hours are guaranteed now going forward. The income will be X between
at
here and
X,
for this financial year.
Right.
And they've accounted for, 3 weeks leave over Christmas and maybe, a bit of leave here and there, 4 weeks in total. But yeah, because if you look at last year, there's only 3 months, but 3 months she wasn't working, sort of thing.
Yeah, so, but it's a 3 months of work, but that's also at the start of that work and working more full time.
So you really have to tell the story there,
leave, and then
to get
you
a
might
true
not go back
picture.
to full time.
To get a true picture of what income this person will have for the financial year based on what is the hours are being done right now. So I think probably ABN with parental leave, we would need to go through one of the specialist teams. Otherwise, typically our standard lending policy through any other mainstream team will just look at the financial year in isolation. They want 18 months on the ABN to 2 years, depending on the bank. Very different. So, these policies are very niche.
And then if you're on a parental leave and your employee, for instance, you get X number of weeks, which is paid by your employer. How is that factored?
So when you've got a fixed salary to return to, it's treated differently. They'll take that as your income for servicing.
Okay.
As long as you have money in the bank to cover your shortfall in servicing between now and when you return. So if you are, taking 6 months off and we have a return to work letter, have a date, a salary, we'll factor that as your income. And then we just have to make sure they've got savings to cover the shortfall in not having that income. They don't look at that. Like, funnily enough, the actual paid parental leave is not factored in to the servicing.
Oh, okay.
Typically not. So
even though
we're looking at return to work income.
Even if it's employer
it's funny. I don't know why.
Okay. So someone who, say, like a staff specialist in New South Wales, they let's just, for argument's sake, let's say they're on $300,000 a year. They get about, I think, 14 weeks of paid parental leave, and say and that's all they're going to take. That income is not even factored
I
in,
would take that to credit.
You should, right?
I would take that to credit. To say there is no gap in income. And then maybe they wouldn't need the savings to cover it, because if there's no gap, like if it's paid for 3 months and we're returning to work at that point on the same salary, different story. But, they might often, especially if it's parental leave, often they might return 4 days or
they might not
3 days.
Full time.
Would look at the future salary for servicing.
Then they would sort of service that. Or if they took half time and then extend it out 6 months, then
exactly.
It's a bit less.
Circumstantial. But there are some banks that are quite good with looking at things with a common sense approach that might be a little bit outside of the policy, but we have access to credit teams that we can talk to up front to say, would you do this? This is the story, and we just build a bit of a case to do deals that might be a bit outside of the square. And I think that adds a lot of uncertainty, especially for female doctors, and that they don't know what's happening during that. The ABN stuff is harder because
when you're a salaried, it makes sense. I think when you're an ABN, if you're still under the threshold, at least you can get that paid parental leave thing from the government. I guess that's the one that they don't factor in.
No, they don't.
They don't factor that one.
No.
But if you're an employee and you get employer paid but parental leave, that is factored.
Well, not usually.
Really? Okay.
No. They usually just want to know, when are you going back and what's your salary? We'll take that as long as you've got yourself covered between now and then.
Okay.
Some of them have, it has to be within 12 months. Some don't have a time frame limit on it. I think the key is, as long as you've got money in the bank, that's what they really want to see. But going back to ABN work is what is more challenging, and that's where I we'd need to go outside of the normal home lending space to talk to a health specialist and get a policy exception. So especially if, someone's gone back to work but their last year of financials had 6 months of mat leave, so we've only got half the income, but we've got the first half of this year on normal hours, we would look to that one to go, hey, we're back to normal hours. Can we project based on
or can we
the
annualize
current?
it based on?
That's right.
Yeah. So there's different ways of doing it.
There's generally ways around everything.
Yeah,
like we always
it's just
need to
about
find
how
a
much
way.
effort, isn't it?
I know.
Yeah.
And so who you know as well.
Yeah.
And yeah, it really is. I think a lot of people, a lot of brokers, even bankers don't know what policies are out there.
And I think that's
around
one of
this
the
stuff.
things where it's useful to use a specialized broker that understands all the lingo.
Yeah,
and
we're doing a
where things
lot
are.
of deals at the moment for doctors on short-term ABN incomes.
Yeah.
And I think truthfully, if they were going to just fit any old broker that has not dealt with a medico, they would say, I can't help you because they don't know.
Yeah. And is that the ones that have like 3 to 6 months ABN?
Yeah. I had a doctor get turned away by ANZ. They were
You
like,
went to the bank directly.
Yeah.
Yeah.
And the banker didn't know that they could do it at ANZ. So I
Yeah.
just think it's such a little niche team.
Yeah.
And they're a business banking team. What they really want is this customer to come on as a business banker. So if they do this for you as a home loan customer, they're really hoping that you will then bring over your business accounts. And if you need business lending or asset finance or anything like that, that you'll use them. So it's sort of just a foot in the door for the bank to get the doctors on board as a customer.
Yeah.
They're like, we'll do this for you, but the business bankers want your business banking as well. They don't force you to, but they're hoping that starting that relationship by doing these policies and getting you in, because doctors are obviously a very low risk customer.
Yeah.
And all the banks want them. So yeah.
Yeah, it's very interesting the dynamic between the home loan, residential bankers.
Yeah.
And then the business bankers, and then there's the private bankers.
Yeah,
It's
that's right. So private is
They don't talk to each other.
no, they often don't. It's very funny. Yeah, I don't know why. They need to come together and I'm not sure why the branch wouldn't have known that was a policy through health, but they obviously just didn't know. Yeah.
And look, that's when there's, I guess, information gaps, there's opportunities for growth and business. I guess that's what we're here to do, is actually help people.
That's right.
Find the right policies and get onto the right loans, and maybe do some servicing that other people have said, oh, we can't do this.
Yeah.
And I think that's something that I've seen quite a bit in the group, is that they would have said, oh, I went to the bank, they said they can't lend me any money.
Yeah, because they will say we need 2 years of tax
we need
returns.
2 years of that. So I guess the one of the major take-home messages is don't take no for an answer.
Yeah.
And if you've approached someone else, such as either as the bank directly or a non medical, a more generic lender, and they've said, oh, we can't do this, it doesn't mean it can't be done.
Yeah.
You haven't exhausted all options.
No.
And I'm going to call us the last resort, maybe. Sorry, just giving you harder work to do. Well, obviously, the salaried people, that's the...
But yeah, the other thing
easy
probably
ones.
is that,
Yeah.
some brokers might put a doctor like that into a low doc type product, because that's an option if you're short term on the ABN to go into like a...
Okay, yeah, tell us a bit more about that.
They're expensive and not through mainstream standard lenders generally. Like they're non-banks lenders. They're expensive on entry costs, interest rates.
Oh, yeah.
Yeah. So they could get told that's your only option. But whereas there are
They don't
major
know the
banks
other
that
option.
will do that.
Yeah. I mean, we've
without
seen some
putting you on low
really
doc.
crazy interest rates, haven't we? Like,
Yeah. Oh my gosh. Yeah. There was one doctor
give us an
that
example. I always love hearing the examples.
Yeah. Elle, my business partner, had a client because we just offered to improve people's rates. Like even if we're not writing the loan, if you've got a bad rate, just let us help you negotiate it. So this lady came through and she was paying like 6 to 8% on a few deals. And Elle just contacted the bank and got them down. And I think it was about 20,000 a year. That's just by saying, hey, these rates are too high. Yeah. I had another client that was on 10% rates with a major bank. And with a click of a button, we got them all down at like 6.
Yeah. That's a lot of money.
I think if you're sitting there thinking that feels overwhelming, I know what it's like. Personal admin goes by the wayside when you're busy. But it's actually not a hard process for us. If we just know just send us a home loan statement. We need to generally, some banks want your phone number or your date of birth or, some identifying info. But we have portals where we can put it through and they'll drop it like in the click of a button.
Yeah.
So it's not hard for us to do that, and we will do that obligation free.
And these are mostly the major banks will.
Mostly majors, but we can do it through some second tiers.
Okay.
We can do like Bankwest. We can do it ING. But tip majors, yes, the portals are very, very good. There are some banks, if we didn't write the loan, we can't approach on your behalf, but a lot of them we can. But I think if nothing else, just reach out and ask if we can help. And if we can, we will. And if we can't, we'll tell you how to do it.
Yeah, and we'll probably more homework for me before this episode goes live is that I'll probably create a form for people to,
we have a form now via our website where you can just log in and review your rate. So you just go on, enter your info, and it'll come to us as an email, and we can contact you and let you know if we were successful. But it's just as in a simple, very simple 2-second form that will trigger that process to begin.
Yeah, awesome. And I've seen a few of these sort of rate checks go through, and we're actually saving quite a bit of money for people.
It makes a difference.
Yeah. Awesome. So now we've talked about the personal aspects of it. There's obviously different structures you can borrow money off, and doctors like to have complicated structures. Family trusts, holding companies, and superannuation. Now, how does that look with each and every one of them? Let's start off with say superannuation, for instance. If you have a SMSF, that's a completely different process, isn't it?
It is, yeah. So non-bank lenders typically where we do always have to work with. AMP is just entering back into this space, interestingly, but otherwise it's all non-banks.
So a lot of the banks
they all pulled out
that space. Why is that?
I actually don't. Yeah, I'm not sure why. It could be regulation. It could have been capacity. I'm not sure. Could be profit.
Yeah.
I don't know. But years ago, they all used to do them and they all pulled out.
They all pulled out one by one.
Yeah, but we still have a lot of lender options for them. The rates on these are a bit higher. They are serviced on the rent, your contributions, essentially. So PAYG, that's quite straightforward. It's your 12% guarantee. If you're self-employed, especially in Medico, we often see people depositing the maximum per annum per person into super just for some tax breaks. So, there are different policies once again between lenders, but if you look at what you're depositing in the last 12 months as a general rule plus your rent that you'll be getting, that's what they're looking at. Okay. And obviously your deposit has to be a minimum of 20% plus costs. But we sometimes see people putting in 30 or 40%. It just depends on the strategy given to you by your advisor, your tax accountant, as to what's best for you. But we do typically see these properties purchased with a buyer's agent because the right investment is very key in super. It's not something you want to mess with by buying a bad investment property. And we often see people buying dual occupancy in these too because the rent is so strong. Yeah, the yields are higher. The yields are very high compared to a standard.
So I guess to summarize, within super, it's assessed based on your rental yield and also based on your contribution. So the two of them added together needs to obviously service the loan.
Yeah, with the buffers factored in.
Yeah.
If you haven't made big contributions and you're self-employed, they can start to look at your servicing ability to make the contributions going forward. So even if you don't have historical contributions, there are options. We just have to dig a bit deeper into your personal servicing as to how affordable it is for you to, like if you say I'm going to contribute 15,000 every year from now on, we just assess your ability to do that. So if that makes sense, outside of super.
And does it matter if it's a concessional contribution or non-concessional contribution, or if it's a SMSF with more than with two different members, that different persons contributing different amounts. It doesn't really matter as long as it meets that threshold, it's fine, right?
Well, they look at the combined.
Of the whole trust. Yeah.
Yes. Yeah.
Okay.
But there are options with some banks to buy with another entity. So if you had your super fund might want to buy a commercial property, for example, with someone else's super fund, there are options there. We don't see that. That's not common.
So it's possible.
It's possible. Yeah.
So it becomes more of an investment into a trust or something like that, rather than a direct ownership.
Yeah. So that's not that common in that what we've seen, but it is possible. But typically we have a couple who have rolled their super into a super fund. I strongly recommend getting
proper advice for that. Financial.
Some people don't.
And accounting advice.
You can set it up without that. And I wouldn't recommend that, I think, because it's important. If you've got all this money sitting in this bank account, it's going to get audited. If you're just not doing anything with that money, because obviously you might put some into the property, you can offset with some banks, but there might be better ways for you to invest the remainder of funds sitting there as opposed to offsetting the loan. You need financial advice, support on those. Right.
So that's SMSF. Now, within trusts and companies, again, that's another different set of lending. And that's more sort of not personal lending anymore. That's more, again, business lending, isn't it?
I mean, there are some resi banks that will that will lend to companies and trusts if they're non-trading. So if they're, they've just set up a company to purchase a property. That some of these can still come through residential. But if it's a trading company, this sort of takes us out into the commercial space. But I think it's a trending topic at the moment. Interestingly, a few banks are pulling back on trust lending. Like Macquarie has actually paused all applications for trusts and companies at the moment. I believe it's a capacity issue because they're very strong on committing and maintaining service levels. So that's just one they've paused. But then off the back of that, I've seen another bank put some limitations on these now too. So there's a lot of social media activity around buying in trusts and how you grow a portfolio by purchasing in trusts and then
keep rolling it.
Which you would have heard of. But it will be interesting to see if there's a lot of changes in that space over the coming year.
Okay. And essentially for those, you can get either a full doc loan or a lease doc loan for the properties that's underneath there. If they're commercial properties, and then if they're residential, it's just the usual
standard assessing. The lease docs are good in that they cover themselves essentially. But they require huge deposits. And they're really quite particular around the conditions of the lease and the lease term. And basically the idea is that the lease will rent will cover your repayment by and some. So that they don't look at your servicing outside of it. So if someone has hit their servicing capacity, outside of that lease stock is a way for them still to be able to invest with a commercial property, but you need a hefty contribution for them. Which some people have.
And so like to break it down, when you start using structures, it's depending on the assets you buy, it can go one way or the other. If it's commercial, there's a whole set of sort of commercial lending requirements, which the lease stock is one of them. And then if you're buying residential under structures, whether it's a trust or company, then there is that still follows roughly the same
similar sort of sometimes we have to go through business banking. But other ways we can do it through the resi teams, but we just have to assess all of those on their individual merits. But I think once you've got a property in trust, super looks after itself. So, and that's the idea. Like when you buy a property in trust, you want that to be looking after itself, where you're not having to put money into it, where the rent's eventually going to cover the costs of running
you
that
can't
entity.
make gear out of it. There's a lot of things you can't do.
But the way people sort of then keep building the portfolio is that once that entity looks after itself, there are banks that will leave that off your servicing.
Yeah.
But once again, like CBA have just come out and said we will only do this for existing home loan customers now.
Oh, right.
So that's another one that's sort of put some
So they're
limitations
clamping
on
down
them.
on that. Yeah.
They are. And that's why I'm interested to see what's coming.
So it's interesting to see what's happening with the banks when we talk about investing, because I think they're trying to predict what's happening, and there's perhaps with the affordability issues, the housing affordability, they are trying to discourage people from having 10 property portfolios and that sort of stuff, because that's viewed negatively, I think, by a lot of people.
Yes.
I guess people who can't own their own homes.
Yes, that's right.
There's a lot of debate about that in Australia about housing affordabilities.
Yeah.
So maybe that's another lever the government can use to clamp down on it, which is
it is getting raised, and I think because lots of people are trying to adapt this strategy. There's a bank that will ask us straight up front, does this person have more than 5 properties held in trust?
Oh, really?
That's a question.
You get asked that question these days?
Yeah, by one particular bank, yes.
Okay, all right.
So, it'll be interesting to see what happens.
So it sounds like they're trying to collect that.
Yeah.
It sounds like they're trying to collect that information.
They are, yes, very aware. But, the fact that one has pulled out altogether is interesting. I'm not sure. Yeah, from what they say, I think it's more of a capacity issue where they're like, we just want to continue without amazing service levels, and one of the volumes were just and are still really, really huge. So they're like, well, how are we going to maintain the service levels? We'll just cut one policy out. Whether it's temporary or ongoing, I don't know. Yeah. But it will be interesting to watch that space.
Okay. Oh, that's some additional insights into what's happening on the mortgage front. I think that's almost going to also predict what's going to happen into the actual market.
That's right.
Because lending is always goes hand in hand with property sales and prices. Yeah.
Yeah.
Awesome. So I think the moral of the story from today's discussion is that lending for doctors is complicated. I think that's the first thing. And life is complicated.
Yeah.
And banks are also complicated. Yeah. And so it helps to have someone there to help you guide through all that complication and get the best policy you can.
Yeah, definitely.
Well, I'm sure there'll be lots of doctors who are going to embark on that journey, and we'll be there to help you.
Yes, I look forward to it.
Okay. Thank you for coming in, Alissa.
Thanks for having me.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.